Topic examines the empirical properties of correlation and emphasizes that correlations observed in financial markets are neither constant nor stable over time. Traditional portfolio theory often assumes fixed correlations among asset returns, but empirical evidence demonstrates that correlations fluctuate significantly across different market environments. These fluctuations are influenced by economic conditions, investor behavior, market volatility, and systemic events. During periods of market stress, correlations across risky assets frequently increase, reducing the effectiveness of diversification strategies. The program highlights that understanding the real-world behavior of correlations is essential for accurate portfolio construction, value at risk (VAR) estimation, stress testing, and overall financial risk management. One important empirical property discussed in the topic is correlation breakdown and convergence during crises. Under normal market conditions, assets from different sectors or regions may appear weakly correlated, providing diversification benefits. However, during financial turmoil, investors often react similarly to adverse information, leading to simultaneous declines across multiple asset classes. This phenomenon causes correlations to rise sharply, especially among equities and credit-sensitive instruments. The topic emphasizes that diversification benefits are therefore most vulnerable precisely when they are needed most. The global financial crisis demonstrated how previously unrelated markets became highly interconnected, amplifying losses and revealing weaknesses in risk models that relied on stable historical correlation assumptions. The topic also explores the asymmetric nature of correlations. Empirical studies show that correlations tend to increase more rapidly during falling markets than during rising markets. In other words, asset returns often become more strongly correlated during market downturns and periods of panic selling. This asymmetry is particularly important for downside risk management because portfolio losses can escalate quickly when diversification disappears unexpectedly. The program notes that traditional linear correlation measures may underestimate dependence during extreme market movements. As a result, risk managers increasingly use advanced dependence models and stress testing techniques to better capture nonlinear relationships and tail dependencies between financial assets. Another important topic is the relationship between volatility and correlation. Empirical evidence indicates that periods of elevated market volatility are frequently associated with higher correlations among risky assets. During turbulent markets, uncertainty, liquidity constraints, and investor risk aversion often lead to synchronized trading behavior. Consequently, changes in volatility can significantly alter covariance matrices and portfolio risk estimates. This relationship has important implications for VAR models, portfolio optimization, and hedging strategies because rising correlations combined with higher volatility can dramatically increase total portfolio risk. The program emphasizes that dynamic correlation modeling is therefore necessary to capture evolving market conditions accurately. The topic concludes that effective financial risk management requires recognizing that correlations are dynamic, state-dependent, and influenced by broader economic and behavioral factors. Historical averages alone are insufficient for forecasting future dependent structures, especially during stressed environments. Risk managers must continuously monitor changing correlations, evaluate potential contagion effects, and incorporate scenario analysis into portfolio management decisions. Advanced techniques such as conditional correlation models, copulas, and stress testing frameworks help institutions better understand evolving interrelationships across markets. Ultimately, topic demonstrates that empirical correlation behavior is a critical determinant of diversification effectiveness, systemic stability, and the resilience of financial institutions during periods of market uncertainty.